Good afternoon, everyone. Thanks again for joining me on the latest instalment of my client update series. I can't believe it's already been a month since the last update, but I hope you're all keeping well. And I'm sure that, with everything that's been going on, we've had, quite a bit of positivity in the past 30 odd days. It's really good to see that we, I guess, don't see things as bad as, probably what we were seeing last month. And it's really great to see that we can get outdoors again, see our family and friends, and slowly get back to some sort of normality. The great thing is these have been reflecting quite well on the share markets as well. So we've been really seeing a lot less volatility, a lot more positivity, and the clouds clearing somewhat. But what I'll do is I'll bring up my PowerPoint here now, and we can go through a few slides and give you a bit of a highlight and an overview as to what we've been seeing and what's really happened over the last month, and give you a bit of insight into the portfolio as well. So just give me a moment while I bring that up for you. All right. So in the past 30 days since our last catch up, we've had quite the comeback in the coronavirus and in the sense of what's happened on the share market. So what we have here is the S&P 500. So this is the index for the top 500 stocks on the American Stock Exchange. So what we can see here is, as we've all known, in February, everything was all fine and dandy, and we were at record highs, both here and in the States. So we can see that the S&P 500 was coming close to 3,400 points. The 200-day moving average is in the yellow line there in the middle. So what we can see, obviously, when coronavirus hit, we went all the way down 34%, and it bottomed on March 23rd. And ever since, it has slowly brought itself back up. And now we can actually see that the S&P has cracked the 3,000 point mark, which is quite a milestone, and it is now back onto its 200-day moving average. So it's been quite a phenomenal comeback with the share market over in the States, and I'll show you the Australian market in a moment as well. But really, the three key reasons for that is one, that the interest rate drops around the world has definitely helped. Obviously, when you're reducing interest rates, you're getting less in the bank, and there is definitely more of liquidity out in the system, as well as giving, I guess, investors really no choice but to put their money into the share market if they want to get some sort of return there. Record government spending has probably been even a bigger one in terms of the effect, whether it's the Federal Reserve, the RBA, or the ECB, even the Bank of Japan. They have been spending billions, if not trillions of dollars on getting money out into the system, buying bonds, buying shares, buying whatever they can to really get the markets moving and to really get out of the doldrums that we saw at the end of March there. And thirdly, I guess, and most importantly, investors are feeling that really the world hasn't suffered as much as what was expected. We're definitely seeing a lot more green shoots. There's definitely a lot more optimism for the future than what there was a month or two ago. And so when investors are optimistic, then obviously that is going to reflect first and foremost on the share market. So really, those are the three key reasons that we're seeing there, but quite a phenomenal turnaround from what was some pretty bleak times. In terms of the comparison between the American market and the Australian, so we can see there the differences in the indices there, and we can plainly see that the two were on track in terms of their performance at the start of the year, so through January and February, and they both dropped quite significantly. However, what has happened is the American market has rebounded a lot more stronger than the Australian. So you can see that the ASX 200 is still down about 17.5% from the highs in February, whereas the S&P 500 is only down about 10%. So there's quite a bit of a difference there. And there's probably one key point that is, I guess, the result or the reason for that. And it's really all to do with the major tech companies that the American market lists. These figures here, you can see I've just put some examples there of four big tech companies that are listed on the American exchange. So you've got Microsoft, Netflix, Amazon, and Apple. They are all up. They are all in the green since the start of the year. So you can see some pretty big moves by a few of them, 16, 34, 32%. These are all positive swings for them. And we need to, I guess, have in our mind to really understand just how powerful these businesses are. The FANGs, as the acronyms like to basically make it nice and easy, is to really show that, you know, these companies, along with a couple other big ones there, they make up 25% of the entire worth of the S&P 500. So they are worth 1/4 of the American stock market. So if they're having a good rally, then that is definitely going to reflect on the total S&P 500 index. And that is really the key difference there that America has, that Australia doesn't. We don't have Microsoft's and Amazon's, Netflix, etc. listed on our exchange. So we don't have that major uplift that these tech companies are receiving, because we are purely moving to more and more of a digital world, and these companies are benefiting from them. Microsoft has all the software that everyone's using from their working from home. People are streaming a lot more and using Netflix. Amazon is delivering parcels, you know, as quick as they can, because everyone's now doing, you know, home shopping. These are the types of things that we need to be aware of, and this just shows how strong these businesses are, and even in weak times, how they can actually be even stronger. Now, in terms of testing and active cases here in Australia, it's really good news that we've been seeing, and I think the numbers are really becoming, you know, more and more positive as we move through. So the top box there, what just basically it's showing is the total cases as well as the active cases at the moment. So far in Australia, we've had 7,139 active cases. Total cases, and the active cases are 468 of that at the moment. So really, there's only about 6.6% at this stage that are still active. So it's a very good number to see that only 468 people in all of Australia have coronavirus at this very given time. The bottom box there just basically shows the amount of testing that's been happening, and really your chances of your positive test results. So in Victoria, you can see that out of all the people they've tested, only 0.37% have actually tested positive there. So I think these numbers really put things into perspective, and I'll put even some further on this slide here. What you have on the bar graph there, so in the pink, is actually showing the amount of daily tests. So obviously that has ramped up quite a significant amount in the past couple of months. But then what we're also seeing with the line graph is how many are actually, you know, positive, and you know, the daily cases that we're getting, and you can see that that has come down, you know, pretty much to a very slow trickle there. So it is really positive to see that the testing is really high, and that the active positive tests are obviously very low. And so far so good, touch wood, that you know, with people starting to move around quite a bit in the past couple of weeks, we haven't seen a big upshoot in positive cases. So hopefully that trend continues, and we can stick you know, to the current timeline of opening the economy and opening back Australia up. There are a couple of things, I guess, moving forward in terms of what to look out for, and what we'll be interested to see what happens. We've got the European Commission. Now they're proposing a 750 billion euro recovery plan, and so that includes 500 billion euro in grants and the rest in loans. So this is already on top of the 1.1 trillion that they've already implemented. So these are just, you know, phenomenal numbers. Now, Japan has also passed an additional $1.1 trillion stimulus package. So now that actually brings their total support for the coronavirus to 40% of their GDP, which is just astronomical. I think Australia's probably about 10%. And by contrast, in the GFC, I think we had about 5% of our GDP that we use. So these are just, you know, unprecedented numbers. Unemployment, industrial production data. So April, May, these are going to start trickling through. These are going to be the first to encompass, you know, what has actually happened through the coronavirus effect. The latest ones we've got is to the end of March, and that was really only at the you know, beginning of all the craziness. So the next bits of data are really going to show more so the full force as to what's happening. Another interesting thing, more Australian based, is the 60 billion they thought they were going to spend on the JobKeeper. The big question is, well, is Scott Morrison, is he going to spend it? Is he going to do something else with it? Is he going to pocket it? Well, we'll see what happens with that. That'll be interesting, because obviously that's a lot of money, as well as the deadline for the JobKeeper, the seeker payments. Now, they're due to finish in September, and there's already rumblings about whether that needs to be extended, or how it will look beyond that. A few people are worried that if they just cut off the money there and then, that there's going to be issues. So it'll be interesting to see what happens with that. I think the review for that is still either in June or July, so there's a little bit of time there to play out for that, but it will be interesting to see just what happens. Now, in terms of ourselves with the portfolio, there's been a few bits and pieces that have been going on in the past 30 days. For those of you that receive the trade advices, you would see that we've been probably doing more buying than selling. And really that is because we're starting, as I said, to see the positivity in terms of the market, both now and moving forward. So what we've started to do is increase our exposure to more cyclical stocks. So we talk about cyclical stocks as to ones that are very leveraged to the global economy. So you're talking a lot of resource companies there. And as you can see, we've got BHP, BlueScope, Woodside, Citigroup, so it's American Bank, James Hardie, Oz Minerals, etc. So these types of businesses were the ones that were hardest hit when all this started to happen. But now that economies are starting to reopen and production is getting back online, these are the businesses that are now going to have the biggest upswing. And so we want to have that exposure to those businesses now that the volatility has calmed down. And we basically used that from the cash that we had hoarded over the past few months. So now the investment team, we see ourselves as more, I guess, as a neutral position. So as before, say, for example, if you're a balanced investor, we had you about 50-50 in terms of defensive growth assets. In the past few months, we had erred more towards the defensive side. So you were getting closer to, say, 60% of the assets in defensive. Now we're going back more so to the 50-50 mark there. So as I said, we're neutral in the middle there. We are obviously seeing positivity, but we don't want to get too far ahead of ourselves. There's definitely going to be more to play out. We're still very weary to see, well, what's going to happen in the second half of the year, and really just how quickly things can come back online, and I guess really just how much debt, etc., has been accumulated in that time. As we've covered in the past couple of times, obviously to reiterate just the value of our asset allocation and our active management. So as I mentioned there, in terms of moving the portfolio, as the example I gave was the balance, the 50-50, that is, what we call the tactical tilting. So we need to adjust our exposure in not only the defensive and growth, but also the specific sectors within those asset classes. So it's not just about whether we're buying Australian or American shares or whatever it might be. It's about the types of sectors that we are exposing ourselves to within those sectors too. So we really need to, have a very good and clear understanding as to the importance of that, because it's not just about buying the stocks. There's so much more that goes on with that. So I hope that you got a good overview as to what's happened in the past 30 days. I really appreciate you taking the time to tune in. And as always mentioned, if you have any queries whatsoever, there's my email, there's my mobile there. Please, get in contact at any time. And I look forward to speaking to you all very soon. Thank you very much and take care.